The U.S. stock market is at a crossroads. For years, it has been a symbol of economic strength and resilience, reflecting the ups and downs of the broader economy. But now, more than ever, it stands at a critical juncture. After a period of remarkable growth, storm clouds are gathering on the horizon. The market has enjoyed a prolonged bull run, with stock prices reaching unprecedented highs. However, this growth has not been without its challenges and critics. Many experts believe the next major move for U.S. stocks will be downwards. The signs are becoming increasingly difficult to ignore. Analysts are poring over data, trying to predict the next big shift. The mood on trading floors is tense, with many bracing for a potential downturn. This prediction comes amid growing concerns about high valuations, mixed economic data, persistent inflation, and escalating geopolitical tensions. Investors are understandably nervous. The economic indicators are sending mixed signals, making it hard to gauge the true state of the market. They are trying to decipher the conflicting signals and make sense of the uncertain terrain ahead. The challenge lies in distinguishing between short-term volatility and long-term trends. Investors are seeking clarity in a sea of information, hoping to make informed decisions. Is this just a temporary blip in a continuing bull market, or are we on the cusp of a significant downturn? The debate rages on, with some experts optimistic about a recovery, while others warn of a looming crisis. The market's future remains uncertain, and opinions are divided. The answer, as always, is complex and depends on a multitude of factors. Economic policies, global events, and market sentiment all play a role in shaping the market's trajectory. Analysts are considering various scenarios, each with its own set of implications. This essay delves into the reasons behind the potential downturn, examines recent market movements, and provides guidance for investors navigating these turbulent times. By understanding the underlying causes, investors can better prepare for what lies ahead. The stakes are high, and understanding the forces at play is crucial for investors of all levels. Whether you're a seasoned trader or a novice investor, staying informed is key to making sound financial decisions. The market's volatility can be daunting, but knowledge is power. By examining the current market dynamics and potential risks, we can better prepare for the road ahead. The journey may be fraught with challenges, but with careful analysis and strategic planning, investors can navigate the uncertainties and seize opportunities in the ever-evolving landscape of the U.S. stock market. One of the most significant concerns for market observers is the current level of stock valuations. Over the past few years, we've seen an unprecedented rise in stock prices, driven by a combination of factors including low interest rates, high liquidity, and investor optimism. This has led to a situation where many stocks are trading at prices that are significantly higher than their underlying fundamentals might justify. Put simply, many stocks are trading at prices that are significantly higher than their underlying fundamentals might justify. This phenomenon is often referred to as a bubble, where asset prices become inflated beyond their intrinsic value. Investors, driven by the fear of missing out, continue to pour money into the market, pushing prices even higher. This disconnect between price and value is a red flag for some analysts. They warn that such a disparity cannot be sustained indefinitely. Eventually, the market will correct itself and prices will fall back in line with their true value. This correction can be triggered by various factors such as changes in economic conditions, interest rate hikes, or negative corporate earnings reports. The law of gravity applies to the stock market just as it does to everything else. What goes up must eventually come down. This is a natural part of the market cycle, where periods of rapid growth are followed by periods of decline. What goes up must eventually come down. When the market is in a state of euphoria, it's easy to forget this fundamental principle. However, history has shown us time and again that markets are cyclical. After a period of significant gains, a correction is almost inevitable. When valuations get stretched, as they are now, the market becomes more susceptible to a correction. High valuations mean that stocks are priced for perfection, leaving little room for error. Any negative news or economic data can trigger a sell-off, leading to a sharp decline in prices. A correction is a healthy part of any market cycle. It helps to reset valuations and bring prices back in line with reality. While it can be painful for investors in the short term, it ultimately leads to a more stable and sustainable market. It helps to reset valuations and bring prices back in line with reality. This process can take time, but it is essential for the long-term health of the market. Investors who understand this dynamic can better navigate the ups and downs of the market. making informed decisions that align with their financial goals. However, corrections can be swift and painful, leaving investors who bought in at the top with significant losses. It's important to remember that investing in the stock market carries risks, and it's crucial to have a well-thought-out strategy in place. Diversification, risk management, and a long-term perspective can help mitigate the impact of market corrections. Understanding this dynamic is key to making informed investment decisions in the current climate. By staying informed and being prepared for potential market corrections, investors can navigate the complexities of the stock market with greater confidence and resilience. Adding to the uncertainty is the current state of the U.S. economy. While some indicators, such as consumer spending, remain relatively strong, others, like job growth, have been weaker than expected. This mixed bag of economic data makes it difficult to get a clear read on the direction of the economy. The Federal Reserve's recent interest rate hikes, aimed at curbing inflation, have further complicated the picture. While necessary to control rising prices, these rate hikes can also slow economic growth, potentially pushing the economy into a recession. Investors are left trying to connect the dots. Is the economy heading for a soft landing, or are we headed for a more severe downturn? This uncertainty is fueling market volatility and making it challenging for investors to make confident decisions. Section 4, the inflation threat, a looming shadow over the market. Inflation has been a persistent concern for investors. Over the past year, the rising cost of goods and services has eroded purchasing power, making it more expensive for consumers to buy everyday items. This has led to a ripple effect throughout the economy, affecting everything from consumer spending to corporate profits. Investors are particularly worried because inflation can eat into the returns on their investments, making it harder to achieve their financial goals. While it has shown signs of easing in recent months, it remains well above the Federal Reserve's target rate. The central bank aims to keep inflation around 2%, but recent figures have been significantly higher. This discrepancy has led to increased scrutiny of the Federal Reserve's policies and their effectiveness in controlling inflation. Economists and analysts are closely watching the data, trying to predict the next moves of the central bank. This stubborn inflation is forcing the central bank to keep interest rates higher for longer, which could have negative consequences for the stock market. Higher interest rates increase the cost of borrowing for both consumers and businesses. For consumers, this means higher mortgage rates, more expensive car loans, and increased credit card interest. For businesses, the cost of financing new projects or expanding operations becomes more burdensome. Higher interest rates make it more expensive for companies to borrow money, potentially impacting their profitability. When companies face higher borrowing costs, they may cut back on investments, delay expansion plans, or even reduce their workforce to save money. This can lead to slower economic growth and reduced corporate earnings, which are critical factors for stock market performance. This can lead to lower earnings, which in turn can put downward pressure on stock prices. Investors often react to lower earnings by selling off stocks, leading to a decline in stock prices. This creates a challenging environment for both individual investors and large institutional investors, who must navigate the volatile market conditions. Furthermore, rising interest rates make fixed income investments like bonds more attractive to investors seeking a safe haven for their money. Bonds offer a more stable return compared to the often unpredictable stock market. As interest rates rise, the yields on new bonds become more appealing, drawing investors away from stocks. This can lead to a shift of funds out of the stock market and into bonds, further weighing on stock prices. As more investors move their money into bonds, the demand for stocks decreases, exacerbating the downward pressure on stock prices. This shift can create a self-reinforcing cycle, where declining stock prices lead to more selling, further driving down the market. Section 5. Global tensions rise, adding fuel to the fire. As if economic uncertainty and inflation weren't enough, investors are also grappling with a backdrop of heightened geopolitical risks. The ongoing conflict in Ukraine, tensions between the US and China, and other global hotspots are adding to market volatility. Geopolitical events can have a significant impact on the stock market, often leading to sharp swings in both directions. These events can disrupt supply chains, impact commodity prices, and undermine investor confidence. The interconnected nature of the global economy means that events in one part of the world can quickly ripple through financial markets, impacting investors everywhere. This interconnectedness makes it essential for investors to stay informed about global events and their potential impact on their portfolios.